Hi, my name is Arkadiusz Trzciołek. I am a fixed income strategist at PKO Bank Polski.
Yields of Polish government bonds increased following an improvement in global market moods owing to the rollout of coronavirus vaccines and expectations for an economic rebound next year. However, the rise in yields has moderated somewhat as Polish 10-year notes fell below 1.30% from the quarter high above 1.40%. We continue to expect 10-year yields to finish the year close to 1.25%. Polish bonds are supported by a moderate supply coming from both the Ministry of Finance as well as the state agencies in the last couple of months. Risk metrics in Poland were also supported as the political agreement on the EU budget and the recovery fund was reached. As the budget standoff was resolved, some positive outcome was visible on the FX market as well, with CEE currencies strengthening. The final meeting of the ECB and Fed in 2020 were garnering investors' attention. The ECB, in line with market expectations, increased its pandemic purchases by €500 billion and expanded the TLTRO program. The Fed refrained from increasing the average maturity of its purchases, only extending the forward guidance on QE. Thus, despite the accommodative stance was confirmed in both cases, the yield curves in Germany and US actually moved higher with no dovish surprises from the monetary authorities. This resulted in narrowing of the spread of Polish 10-year bonds versus German bonds and US treasuries towards 185 basis points and 35 basis points respectively. Nevertheless, the rise in safe haven yields was modest, as the large number of COVID-19 infections combined with tightening of related restrictions is still in the back of investors' minds. Despite the gross net issuance of 62 billion zloty of treasury bonds this year, the net sale was actually negative in recent months, as the Ministry of Finance focused on switching auctions. The authorities were mostly buying back bonds maturing in 2021, which translated to roughly 14% of pre-financing of next year's borrowing needs. The Ministry of Finance refrained from selling new bonds as it holds a historically high liquidity cushion which remains above 110 billion zloty. The burden of new issuance was partially borne by state agencies. The combined issuance by State Development Bank and State Development Fund reached 165 billion zloty this year. The proceeds are being used to finance anti-crisis measures. The net negative issuance of government bonds in recent months was among factors that led to a narrowing of asset swap spreads, which are close to 2020 lows, around 10 basis points in the 10-year tenor. The agreement on budget during the latest European Union summit was also preventing any rise in Poland's credit risk. The risk of budget veto from Poland and Hungary could have resulted in a sell-off should other EU countries seek a solution bypassing the Central European partners. The latest MPC meeting proved that the accommodative stance is likely to be maintained not only in the core markets, but in Poland as well. Although authorities are unlikely to cut rates to a negative level, they see any hikes being distant as well. Hawks remain in the minority within the MPC, even with inflation holding above the 2.5% target in the central bank forecasts. The market agrees with the MPC in the short term, but began pricing in a modest rate hike in 2022. The National Bank of Poland is likely to focus on asset purchases in terms of further monetary policy easing. The NBP purchases amounted to 107 billion zloty this year. This translates to about 7% of outstanding government bonds and almost one-third of state-guaranteed bonds sold this year. The central bank can also intervene in the FX market, as in December it decided to do so to depreciate the zloty for the first time in 10 years. The MPC has long suggested in its statement that the pace of recovery may be reduced by the lack of a visible and more durable zloty exchange rate adjustment to the global pandemic-driven shock. We expect that in the near term, short-term rates will be anchored close to the reference rate of 0.1%, with 2-year bonds yielding around 0.05%.